Today, we're going to be talking about one of the most common questions I get asked, and that is, what do you invest in? I get asked this question so much, and it doesn't make sense to me why people are asking me this question. It's not like I'm super wealthy and I made it all from trading stocks and investing. It's not the case. You can get wealthy, but that's not my case. And it's not going to be an exciting answer. Since I get asked this question so much, I decided just to make a video about it. And if you ask this question in one of my workshops and I sent you here, this is the reason why. There's going to be a lot of information, but also it's going to be a very simple answer. I basically invest in total market index funds. The last time I checked, more than 70% of my assets are invested in that alone. Obviously, a good portion of it is in the home and in cash for emergency funds. Roughly around 70% or so is invested in total market index funds. That's a very boring answer because I'm not investing in single stocks or anything that is what we would define as hypergrowth or something that we can get rich overnight. I would argue that most of the time that doesn't exist. You might be wondering, what exactly is a total market index fund? The best way to explain it is to go back to the basics and break it down a little bit more. Mutual funds is something that you hear a lot about, especially if you are just starting your investing journey. A good way to put mutual funds is you are investing in a lot of financial assets by buying a portion of it. Right. So instead of buying a stock of Apple, buying a stock of Google, buying a stock of Disney, you can put money into a mutual fund that contains all of those stocks already, and for a much lower price than buying each of those stocks individually. And the whole point of doing so is that you can diversify your risk. You can diversify your risk for a much lower price than if you were going at it by yourself and buying all those stocks individually, or any financial asset. It doesn't have to be stocks. A mutual fund can contain a multitude of financial assets. And then there's a type of mutual fund called index funds. And index funds are basically mutual funds that only contain assets specified by the index. An index is an arbitrary term to describe a group of financial assets. Someone somewhere decided, hey, these assets, I'm going to call them an index. Right? For example, if you wanted to create an index with the 500 largest US companies, we have that. It's called the S&P 500. And there are other indexes as well. Anyone can create an index. Usually it's a financial profession, and they decide, hey, the index is going to have a certain theme, and we'll say all these assets fit that theme, and it'll be that index. If you don't understand what index is, that's completely fine. A total market index fund is even simpler to explain because there is a much more fine definition for what it is. As the name suggests, a total market index fund contains most, if not all, of the US stocks in the entire stock market. Hence the name total market index fund. Total market meaning all of the stocks in the US market. Now you can think about it like this. A mutual fund is the umbrella term. An index fund is a type of mutual fund. And a total market index fund is a type of index fund. So sort of like an umbrella that goes down and you funnel down to these terms. And that's exactly what I invest in. I put most of my wealth in a total market index fund. For those of you who are coming from the bond video, you know I don't have bonds, at least not right now when I'm filming this video. When I say a mutual fund, it's equivalent to an ETF. So if you're going to ask, hey, what about an ETF? Same thing. My answer still stands. There are still total market ETFs. So take a look at those. The idea is roughly the same. There used to be large differences between mutual funds and ETFs. Now, not so much. It's really more of a preference in an investing style. So everything I say will apply to both of those. You might be wondering, why would Alan invest so much of his wealth in the total market index fund? Does it make sense? Is it logical? Right? What are the benefits? What are the cons to doing so? And before I dive into that, it's very obvious if you're looking at a total market index fund. Usually it will say in the name of the mutual fund, total market. And you'll find it basically across any platform that you're investing in, as long as they have mutual funds, right? Charles Schwab, Vanguard, Fidelity, they all have it. The biggest thing that investors always bring up is diversification. The total market index fund definitely gets the job done here. In case if you're wondering how many stocks are actually in the total market index fund, it's roughly around 3,000 stocks. That's a lot of stocks if you really think about it. So how can you get more diversified than investing in the entire stock market? You can, theoretically, right? You can invest in things that are not in the stock market. But since I am on the younger side and my time horizon for investing is very large, over 30, 40 years, in that case, then it makes sense to invest in riskier assets. And that in this case, we're talking about stocks. But when you invest in risky assets, you still want to be diversified. So the best way to be diversified is just to invest in everything, right? You don't have to choose, you don't have to pick. As long as the stock market does well overall, then I'm making money. If you think about it like this, the chance of all 3,000 plus stocks failing and not recovering is extremely low. There's a lot of factors at play here that probably won't even let that happen. So there's a lot of benefits to investing in everything versus a small subset of stocks, right? Or a small subset of industries. Invest if you have your foot in everything, how can you possibly lose? Some people might say, why are we stopping? Why are you stopping at the United States? There's so many other countries out there that are rapidly growing that you can be investing in and making money in. And that's why when people talk about diversification, they also talk about the fact of globally diversification, right? Investing in other countries or companies from other countries. There's a lot of ways to think about it, but the way that I think about it is a lot of the companies in the United States, especially the largest ones, are already global, right? You can think about Coca-Cola, you can think about Apple, right? So a lot of companies are already diversified globally, and they're just United States companies. At some point, you could make the argument, hey, what if the United States isn't the largest economy in the world and some other country takes it over, right? That could happen in the future. And once that does happen, then maybe it's worth reconsidering if I should invest all of my money in total market index funds versus investing and diversifying more into the international markets, right? If you believe that the total market index funds is not diversified enough, and you believe that the world economy is growing at a much faster rate than the United States, there's also the option of investing in world index funds. Some of these world index funds are usually called the world market index funds. And they try to invest in everything. All the companies in the world, at least the largest ones that are on stock exchanges, you can do so through that. But I would say the same ideas apply to the world index funds or the world market index funds as well as the total market index funds. They're very similar in a regard, right? The world market index funds probably will, a big chunk of it probably will be still the United States. Now that we're done talking about diversification, the next point I want to bring up is fees. We don't pay fees anymore. After Robinhood introduced no fees, basically every other major brokerage followed them, and you no longer have to pay fees for stocks. But here's the catch. For mutual funds, you do have to pay fees. And they're sort of hidden in a way, right? You don't pay them upfront. There's various fees you have to pay, but the one that's most prominent and that comes up when we talk about total market index funds is expense ratios. Expense ratios is something that fund managers charge on a yearly basis, and it's usually a percentage of the amount of money that you have invested with them. Expense ratios usually vary depending on the amount of work that a fund manager is doing. Right? Fund managers are responsible for making sure that your investments are growing, they align with whatever the objective and goal of that fund is. In the case of a total market index fund, they just have to make sure that it's invested in most of the US stocks. And since fund managers aren't doing that much work comparatively, the fees are going to be much lower. If you compare some of these fees to other index funds or other mutual funds, you'll find that they're much higher and total market index funds are much lower. As of today, I know that some of my fees are around 0.03% or 0.04%. They have very low expense ratios. So low fees is a huge part, because if you think about it, if you invest money, and if a chunk of it goes to your financial planner or your advisor or fees of any kind, then you're just losing money, right? You have to make enough money to beat those fees plus whatever return that you're looking for. Another major point here is time. Time is so important. Total market index funds are something that is very risky inherently because you're investing in basically entirely stocks. If you decide to diversify, that's a different question. If you're like me and you have most of your wealth in total market index funds, my wealth basically fluctuates with the stock market. If you see the US stock market doing really well, that means I'm making a lot of money. If you see it doing really poorly, like in a recession, you know that I'm losing money. It's really a cyclical. So as all recessions in the United States are so far, and they go down, but they come back up, and usually they come back higher than before. If you look at how the US economy works and how the US stock market works, generally that's a trend, right? We trend upwards. Can that happen forever? I don't know, but it's been happening for the past 100 years. So I can be pretty sure that's going to keep going, at least as far as I know. The key thing here is that I'm able to stay invested long enough for the total market index funds for it to make sense. If I feel like at any point I need to withdraw money and we are in a recession and I have all the money in the total market index funds, I'm going to lose money. We are not in that situation. I'm really investing for a really long-term goal, 30, 40 years out in the future. Since that's the case, I'm not too concerned about withdrawing my money when there's a recession. My next point is something that I mentioned at the beginning of this video, right? I'm not sure why everyone wants to know what I I'm invested in, because it should not dictate what you are investing in. All of us are financially different. We all have different financial backgrounds. And so it doesn't make sense that you want to invest in the same thing that I'm investing in. These are my choices based on where I'm coming from. This video can be part of your research, but it should not dictate what you invest in. So with that said, let's talk about in what circumstances I wouldn't invest in total market index funds. If I'm thinking about short-term investments, right? If I'm trying to buy a house next year, for example, maybe I shouldn't invest in total market index funds, because what happens if there's a recession next year? Basically gonna lose all my money when I need to withdraw it to buy the house. Or I might have to wait much longer to purchase a home. That's something to consider. I mentioned when I say long-term, I really mean long-term. This should not be a short-term investment. It's not for us, and that's why it works. If you're thinking about a short-term investment, maybe consider stuff like cash, maybe consider stuff like bonds, right? That are much more safer, and sort of chances of you losing money on those investments are much lower. If you're looking for quick exponential growth, this is not it, right? Total market index funds take time to grow, right? So if you're looking for exponential growth that flies and you can make a lot of money really quickly, also means it's more risky. This is not an investment for you. If you're looking for that, you can look at Dogecoin, for example. That's one of those investments that can be exponential in growth, not guarantee, obviously. Total market index funds are for those who can afford to wait and see the growth over time. Right? It's a great investment if you're thinking about retirement, if you're thinking about purchasing a home much further out in the future. You also have to keep in mind riskier exponential investments, YOLO investments can cost you a lot of money, right? So it's important to do your research and really know where you're headed when it comes to either short-term investment or long-term investment. Again, everyone's goal is different, and it's important to figure out where you stand on that. People have come up to me and asked me a few questions about, can total market index funds fail? The answer is yes. Any financial investment can fail, and because every financial investment has risk associated with it. I can think of one example where it would fail. If we were to have a world-ending scenario, then the total market index fund would fail, because for whatever reason, all companies across the board cannot perform and the world is ending. But at that point, you might have bigger problems. So for me, it's a risk that I'm willing to take. It's really hard to imagine a scenario where the US stock market fails, has a recession or a depression, and does not recover, right? The road to recovery might be really long, but it will still recover, right? I'm sure you can name a few economies in the world where they did have recession and they still haven't recovered to this day, right? I don't think the United States is in a similar situation, but if you do, then maybe that justifies investing and diversifying in other assets versus just the total market index funds. And so like I said, everyone's a different level of risk tolerance, and it's up to you to figure out where you stand. But now I'm mostly invested in total market index funds. Thank you for watching, and hopefully now you have a better idea about what I'm invested in, why I invested in it, and maybe, just maybe, it might be a good investment for you given your financial situation and how much research you do on your own.